Hello, welcome to the introductory session of Unit 2 for the course Banking Regulations and Operations. I, Dr. Prasanna, Faculty, Department of Management, will take you through this unit. In this unit, you will be studying about the basics of Negotiable Instrument Act 1881 in India. One of the most significant aspects of banking transaction is the negotiable instruments. In NI Act, which offers a great assistance in comprehending what exactly a check, a negotiable instrument, a drawee, what is endorsement, and what is maturity. Furthermore, the Act deals about the liability of a drawer and a drawee, and how the liability is being discharged. NI Act is very well known for its peculiar provision of dishonor of check, which strives to create a civic wrong into a criminal liability. The NI Act offers various such provisions, which is very important for every individual to know. We all have heard about check bounce, but what does a check bounce exactly mean? This Act offers a comprehensive learning mechanism regarding the banking transactions, which is very peculiar in our nation, as various provisions of NI Act are being regularly and consistently practiced in all banking aspects. In Unit 2 of the course Banking Regulations and Operations, we shall deal with the following topics: negotiable instruments and their characteristics, payment of checks and protection to the paying banker's dishonor of checks, payment of check and other instruments, crossing of checks, functions of banker, collection of checks and other instruments, protection to the collecting banker under Negotiable Instrument Act 1881, endorsement of checks and bills of exchange, different types of endorsements, forged endorsements, holder of value, holder of payment in due course. Before moving on to Unit 2, the content of Unit 2, let us just understand the basics of negotiable instruments, how it has evolved, how it has been emerging, and what is the latest things that is happening in the field. So the payment system which has been existing in India has to be understood first before getting into the concepts of Unit 2. So the evolution of payment system in India, it actually has a very long history. The payment instrument and mechanism, you can say the earliest was like we were using coins which were either punch marked or even casted in silver or in copper. While the coins represent a physical equivalent of credit system involving bills of exchange facilitating interswaptial transfers. So we all know that we had some kind of coins that were which was being used in practice. So that comes in the later stage of barter system, and so these coins which having some imprints, which different imprints has different value for it, and again the material that has been used also gives a different value for the coins that has been used. So this was the first thing which has been came into existence. In ancient India, loan deeds were called as Rinpatra. They contain details about the debtors and the creditors and the amount of loan and the rate of interest which it bears. The condition for the repayment and the due date for the repayment, everything had been detailed out in the Rinpatra. So the deed was witnessed by a person and of respectable means, that is whoever is in the society, maybe like they call it as sarpanch, or that is a village head, or the person who is having some creditable worth, or who is having sufficient wealth enough, so they will be taken as a respectable person there. So by a respectable person by means of an endorsement to the loan deed for the writer. That is same like what is happening now. In case the witness who is being signing the document will be the person who is responsible in case the debtor fails to pay the amount. So the execution of the loan deed continued even during the Buddhist period. So they were called Inapana. In India, the history of loans dated back even during the Mauryan dynasty also, and the instruments were called as Adisha, which was an order for a banker for him to pay to the person, to the desired person who has been giving the order. So which corresponds to the definition of a bill of exchange as we understand it today. So even during the period of Mauryan dynasty, we had the concepts of this bills of exchange which was in practice then. The loan deed, even during the Mughal period, there was something called as dastavez. So dastavez were of two types. So one is for payable, which has been payable on demand. The other one has been which has been used to payable for us, which after a stipulated period of time. In Mughal period, we had the testimony of many foreign traders who was visiting India, and they were being given some bills of exchange because in India, they had a greater wealth, and the trades were happening in a larger scale, and therefore when people came out here, so they took up this bills of exchange instead of the monetary value for the goods what they traded here. And from their writings and from the old scriptures, it could be very well known that many foreign countries were been involving in this kind of trade, accepted these bills of exchange. More particularly, these were being dealt with regarding to the seaborne trades. The bills were widely accepted and were traded at even discounted rates, as the discounts include the insurance premium covering the risk representing the safe of arrival of the goods. So pay order were also being used during the Mughal period, and they were called as bartaris, and were we can say it as a replica of what we call at present called as checks and drafts. Then the importance of the credit instrument that evolved in India were being termed as hundis. So there is a most widespread, this is one of the most widespread form in the 12th century also, and it has continuing till now, and it has been continuing till now as well, in the sense that they represent the oldest surviving form of credit instrument. Hundis were used as remittance instrument, that is to transfer funds from one place to another, as a credit instrument to borrow money, and for the trade transactions as a bills of exchange. These are some specimen form of hundis, so you can see all these specimen form. Even just you can Google and find out all these specimen forms. So in the modern sense, it has origin. The modern form of money, it has its origin even during the 18th century. Amongst the earliest issue were those which has been issued by the Bank of Hindustan. The Paper Currency Act of 1961 conferred upon the Government of India the monopoly for issue of notes, which were being earlier with the private banks and other banks that were being established in those days. So all those were being consolidated, and the Government of India took over the issue of or printing of the currency notes in India. So these were some denominations that were in existence in previous. So the Presidency Bank and the Bengal Bank were the one who introduced the other payment instruments in India. The checks was being introduced by the Bengal Bank, and which was being as the first joint stock bank established in 1770. So these are some specimen of the we can call it as like checks format, what was being previously that was being followed. So buying and selling of bills of exchange became one of the items of business to be conducted by the Bank of Bengal in 1838. In 1881, the Negotiable Instrument Act came into existence to formalize all these transactions like checks, bills of exchange, promissory note, etc. The NI Act provided a legal framework for non-cash paper payment instruments in India, because we know that these are all non-cash payments, but it is equivalent for cash, and therefore to formalize these, the NI Act was enacted in the year 1881. So once you complete this unit, so this was generally just an introduction part of what has been to be covered in the unit 2 regarding what topics will be covered in unit 2. Once you go through the complete concepts of unit 2, you will be able to understand the meaning and essential characters of what on the different types of negotiable instruments, describe the meaning and marketing of checks, and crossing of checks and cancellation of crossing of a check. Explain in capacity and liability parties to the negotiable instrument, and understand the various provisions of Negotiable Instrument Act 1881 regarding negotiation, assignments, endorsements, acceptance, etc. of a negotiable instrument. Fine. So with this concept, we come to the conclusion of the introduction part of unit 2. So for those students who are interested in having an advanced learning or having some higher end thinking of the same concept, we can use these two sources for, and these two courses are available in those Coursera and Udemy, wherein you can register yourself and you can take up the course, and you can have some advanced learning and come to know about the recent technologies or recent financial things which has been fintech, what we call happening, that is in this banking environment. Thank you.